Yes. So now chapter name depreciation. So first thing we have to see what is the meaning of depreciation. So what do you mean by depreciation? Can anyone tell me? Depreciation. We have seen this, we have heard this term several times, and we have seen this term several times. In accounting also there is a depreciation, accounting is there. In tax also there is a depreciation. So what do you mean by this? So it is nothing but a gradual decrease, we can say, in the value of asset. Suppose if you have purchased any asset, so that is a fixed asset or it is a current asset. So usually for fixed asset there is a depreciation. So suppose if you have purchased any motor vehicle today, immediately from tomorrow depreciation will start. For every year we can assume that 5 to 10% depreciation is there. So depreciation, we can say it is a gradual decrease in the value of the asset due to wear and tear, or else for we can say due to overuse of that particular asset, caused by the use in the business over a period of time. So that period may be 1 year, that period may be 5 years, or that period may be 10 years. So there is a short term concept also, there is a long term concept also, but depreciation is charged every year. Every year from the cost price we have to deduct depreciation, then we will get a final actual value of that particular product, and we have to consider useful life also for calculating depreciation. So now we have seen the brief meaning of depreciation. It is a cost spread over anticipated life by charging depreciation every year against the profits of the business. So first we have to identify whether firm is making a profit or whether it is going through loss. So if there is a profit, then it is charged against profit. So from the profit you are reducing the value of depreciation. But from the point of view of taxation purpose, we are concerned with block of asset. So what do you mean by block of asset? Block of asset is nothing but it is a group of asset. Every group of asset has certain rate of depreciation. So that depreciation rate we have to identify, and we have to remember that particular rate. So now if you see here, next thing, section 2 clause 11, block of asset, given several things. That is, block of asset means group of asset falling within the certain class of asset. Let us say building is one block of asset. Building may be 10% building may be there, or there may be 5% building. Then similarly furniture also 10% furniture may be there, or else sometimes 5% furniture may be there. Then comes plant and machinery. Again, that is a separate block of asset. For plant and machinery, 15% is the general rate of plant and machinery depreciation rate we are talking about. Then 30% rate is also there. So depending upon the circumstances, we have to make a block, then we have to charge depreciation. So first here we have to see, block of asset means group of asset falling within the class of asset comprising. So it has two type of asset. One is a tangible asset, and one more is intangible asset. So tangible asset, we know those assets which we can see and touch and feel. So those assets are known as tangible assets. Like a building, we can see building, we can see machinery, we can see plant, we can see furniture. So all those things comes under tangible asset. Then comes intangible asset. Intangible assets are generally services. All types of services comes under intangible asset. So now if you see here, certain know-hows, certain patents, copyrights, trademarks, licenses, all these things comes under intangible asset. So first we know the meaning of depreciation. Then we discussed brief about block of asset, section 2 clause 11. Next thing, we have to see method of depreciation. So this format is very essential from the point of view of examination. Why? Because as per this format we are calculating depreciation value. So what we are going to do here, first thing we have to identify, we have to remember one thing, that is WDV, that is written down value method. So under depreciation there is various methods are there. SLM method, that means a straight line method is there. Then reducing balance method. Reducing balance method is nothing but a return down value method. So as per the return down value method, we have to see this particular format. See this now: depreciation shall be allowed on the return down value method at the rate prescribed as follow. So particulars and amount column is given. So first thing we have to see return down value of the block at the beginning of the previous year. So we have to identify the previous year first. So this is suppose this is a assessment year. So that is 2021-22 is the assessment year. That means previous year is 2020-21. So from where does this 2020 starts? That is from the financial year 1/4/2020 till 31/3/2021 is our previous year for this one depreciation purpose. Then what is the assessment year? Assessment year from 1/4, that is 1st April 2021 to 31st March 2022 is our assessment year, or we can say it is our present year. So we have to know the difference between assessment year and previous year. We want here return down value of the block at the beginning of previous year. Generally this value is given in the question, so directly we can write that particular value in the format. Next, add asset falling within the block acquired or purchased during the year. So we have to add certain things. Any addition made to the asset. Any addition made to the asset means, suppose if you have purchased any additional asset, or suppose if you have purchased any additional motor car, truck, if you have purchased any truck. So all those things comes as an addition that you have to add to the return down value. First return down value of the previous year we have to write, then we have to add purchases or addition. After adding the purchases, you will get one total, that is nothing but return down value beginning plus this purchase value. If you add both, you will get one total. From that you have to deduct sales proceed of an asset. Suppose if you have made any transfers, proceed is nothing but if you have made any transfer to the some other parties, or suppose if you have made any sales, that you have to write under sales. So sales we have to deduct, purchases we have to add in the return down value method. Then you will get one more total, that is a return down value before depreciation, and it cannot be negative. Return down value before depreciation, it cannot be negative. So this is very clear. That means what you can say, suppose a return down value is negative. In that case, what we are going to do? Can anyone tell me? If return down value is negative in this block of asset or depreciation method, what we are going to do? Yes, can you tell me now? WDV, if it is negative, so we can treat that as a loss. We can treat that as a capital loss. And if it is a positive and some profit is made, then we can treat that as profit, capital profit. Short term, we are talking about short term capital loss and short term capital profit, that we are going to discuss while solving the problem. Next thing, from return down value before depreciation, less we have to deduct depreciation. Depreciation as per percentage of return down value. That percentage will be given in the block of asset table. There is one separate table is there. Under that various percentage rate is mentioned. So that we have to see. Various percentage rates we have to see. As per that we have to calculate depreciation. Then finally we will get a closing return down value or return down value after depreciation. See this, before depreciation, once we will get the return down value, then after depreciation again we will get one return down value, that is return down value for the first day of next year. So this is how we are going to solve the problem. This is a format of the problem. So I hope you have understood this format. Very simple format. First you have to identify the return down value of the previous year, then you have to add purchases, deduct sales, then you will get return down value before depreciation. From that you have to deduct depreciation, you will get return down value after depreciation. So anything you want to ask regarding this format, you can ask me now. Yes, tell me. Any doubt regarding this format? Anuj.
Could you repeat it, sir?
Should I repeat the format again?
Yes, sir.
Yes. See this. Depreciation. For depreciation under written down value method, there is one specified set of procedure is given or mentioned in our syllabus. So that we have to see. First one, under particular, there are two columns, particular and amount. There are two columns. So now, written down value of the block at the beginning of the previous year means, so now in the problem what they will do, they will give you several block of assets. So they will give you furniture, they will give you plant, they will give you truck, they will give you car, they will give you building. So in that case, a lot of columns you have to do. Lot of columns will come, one particular column, then lot of concerned block of asset columns will come. Sometimes patent comes, and sometimes computer, sometimes book they will ask. So all those columns we have to do, and in that column we have to write written down value that will be given in the question. Then next thing, you have to add all the purchases made during the previous year, that you have to add. From that you have to deduct all the sales. See this, sales includes compensation received also. Sometimes asset may be damaged. Sometimes asset may be damaged due to certain events like accident. Suppose some accident happened to scooter, or sometime accident can happen to a truck. So in that case, compensation or compensatory amount will be given by the insurance company. So that compensation amount we can consider as a sales value. That means you can consider that amount as a sale. So you can deduct that amount. Sale figure you can deduct, or any compensation you can deduct. Then you will get written down value, that is before depreciation. It cannot be negative. That means it has to be a positive answer. Then less you have to deduct depreciation. That is as per the rate. That we have to discuss later. Finally, you will get opening written down value for the first day of next year. So I hope now this is clear. Format is very simple. Purchases, add, sale, minus. That's it. And you have to observe certain things. So now next thing we have to see here is amount of certain rules or some notes are given. That we have to see. First one, amount of depreciation cannot exceed total block of assets beginning of the year plus assets purchased during the year. So what do you mean by this? Amount of depreciation means this answer. See this answer, less depreciation answer is there, right? So this answer cannot be more than these two answer together. These two answer means written down value plus purchases. So that is one basic rule. Then depreciation is not charged in the following two cases. So depreciation is allowed in almost all the condition, but there are two exceptions to the rule of depreciation. So that we have to see now. Exception to the rule of depreciation. See this. Now, when sales proceed exceeds the amount of written down value at the beginning plus purchase, excess shall be treated as a short-term capital gain. So now we are talking about sales proceed. Sales proceed means what? This amount. See this. Sales proceed means this amount. If it is exceeds the written down value plus purchase, that means 1 plus 2. If 4 is more than 1 plus 2, then what happens? Then in that case there is a capital gain. That capital gain we can treat as short-term capital gain. Why we can treat that as a short-term capital gain? Because we are calculating the depreciation for 1 year. Every year we are calculating depreciation, every financial year. That is why usually short-term gain means less than 12 months or less than 3 years. So here we can consider this gain as what? Short-term capital gain. Similarly, now when the block value of the block before depreciation is positive, now value of the block before depreciation they are talking is positive. That means this answer. This answer is positive, but a block does not have any asset. What do you mean by block does not have any asset? Block ceases to exist. What do you mean by block ceases to exist? Suppose first at the beginning of the financial year there is one truck, but during the financial year you have sold the truck. Then whether there is a depreciation, if you sell the truck during the financial year, there is no depreciation. So that is why in that case what happens? Block ceases to exist. That is why if you see in such case, positive value shall be treated as, in such case what happens? Positive value shall be treated as short term capital loss. First one is gain, second one is loss. So these two exceptions are there for depreciation. Next thing is how to compute depreciation. So this rule is again very important. Significance of date of purchase. So in the question they will give you date of purchase, date of putting the asset into use, and date of sale. There are three types of date will be given in the question. One is date of purchase of the asset. Let us say date of purchase is today, May 10th, 2021. Date of purchase is May 10th, 2021. Date of putting the asset into use when the lockdown gets over. That is 24th of May. So 24th of May 2021 is what? Date of putting into use of an asset. Then date of sale of an asset, that is somewhere around December. That is let us say December 5 is the sale of an asset. So now what we have to see, whenever we have three types of date, we have to observe date of putting the asset into use. Why? Because on that date, because on that particular date or as per that particular date, we are going to calculate depreciation. Date of purchase is of no use when date of putting the asset into use is given. When date of asset is only given, then we will assume that date of purchase of an asset itself is the date of putting the asset into use. So that is very clear. Then next thing, date of sale of an asset, that is of no use from the point of view of depreciation. So only thing we have to see, date of asset putting into use. So now significance of date of purchase, any asset, see any asset by the SSE during the previous year and put into use in the same previous year for less than 182 days. So 1 year, we know, see this now, 1 year 365 days, 1 year usually 365 days, leap year 366 days. So half of that is 182 days. But from the point of view of depreciation, what we are going to do, we are going to consider 180 days, not 182 days. We are going to consider 180 days, that is approximately 6 months. So if asset is used for less than 6 months, then you have to charge half of the depreciation. Why you have to charge half of depreciation? Because asset is used for half of the year only. That is why you have to charge half of depreciation. Next, if asset is used for more than 6 months, then you have to charge full depreciation. That is why date of purchase and date of asset putting into use is important. Suppose now asset is purchased in the month of December. In that case, how you are going to charge a depreciation? Can you tell me? How you are going to charge depreciation? December you have purchased the asset. December 1, let us take the example. December 1, 2020. December 1, 2020, you have purchased one asset. In that case, what you are going to do? First, you are going to calculate a normal depreciation. That is nothing but 100% depreciation. Normal depreciation means what? 100% depreciation. Then after that, we know that less than 180 days, because of course December has 31 days, January has 31 days, then February 28 or 29, March 31 days. Of course it is less than 180 days. So in that case, what happens? In that case, we have to take 50% of that 100%. So this we have to keep in mind while solving the problem. So here, see this, an asset acquired by the SSE during the previous year and put into use in the same previous year for less than 180 days, the depreciation in the respect of such asset is restricted to the 50% of normal depreciation. This is very clear. Significance of date of purchase. And one more thing here they have mentioned, one note is there, that is depreciation has to be charged from the date on which the asset shall put into use, not from the date of purchase. This we have already discussed. So any doubt regarding this, any question regarding this, date of purchase, date of putting into use, date of sale, rate of depreciation, 180 days more or 180 days less, any doubt regarding this you can ask me now. Just tell me, have you understood this significance of date of purchase?
Yes.
Yes. Narasimha is saying yes. What about others?
Yes, sir.
I hope everyone understood this one. See this. Now, after this one, next thing comes is additional depreciation. First is a normal depreciation, then is a additional depreciation. See, normal depreciation means for one particular year we are giving the depreciation. That is normal depreciation. In normal depreciation, if it is less than 180 days, again we can give depreciation reduced by 50%. Then additional depreciation. Then what do you mean by additional depreciation? Additional depreciation is nothing but it is some type of extra depreciation charged when you purchase plant and machinery. So this specific depreciation is available only in the case of plant and machinery. See this. In the case of newly purchased plant and machinery other than ship and aircraft acquired or purchased and installed after 31/3/2005. If it is before, no additional depreciation is allowed. If it is after 31/3/2005 by an assessee engaged in the manufacture of or production of any article or things, additional depreciation at 20% and 10% if it is used for less than 180 days of actual cost of such plant and machinery will be allowed as a deduction. So that means sometimes in the they will give you plant and machinery 15%. First, what you have to do, first step, charge normal depreciation. Second step, see whether date of purchase is less than 180 days or more than 180 days. If it is more than 180 days, well and good. First step is over. If it is less than 180 days, second step is there. What is that? Reduce the normal depreciation by 50%. Then next again we have to see whether there is any purchase of plant and machinery during the relevant previous year. If there is any plant and machinery purchased during the relevant previous year, again on that purchase you have to calculate normal depreciation, then you have to calculate additional depreciation. This additional depreciation is at 20%, fixed rate 20% you have to give additional depreciation. Then again you have to see that purchase whether it is more than 180 days or less than 180 days. If it is less than 180 days, that 20% additional depreciation can be reduced by 50%. That means 20% instead of 20% you can write directly 10%. Half of the depreciation is charged since the asset is used for less than 180 days. Or else what you can say, 20% into 50%, then you can get again same 10%. So this is the meaning of additional depreciation. It is allowed only in the case of purchase of plant and machinery. Then certain note is given. See this, additional depreciation shall be available only on plant and machinery and not on other assets like furniture and building. So furniture and building is also fixed asset, but on that additional depreciation is not there. Only on plant and machinery you have to give additional depreciation. So you have to remember, whenever in the problem if there is a plant and machinery is given, that means you have to compute more steps, you have to calculate more steps, and problem will be lengthier because of additional depreciation. So you will come across 4 to 5 steps, we can say, if additional depreciation is given. If additional depreciation is not given, then problem is very simple as per the format. So I hope this additional depreciation concept you have understood now. So any doubt regarding this additional depreciation?
No, sir.
no doubt. So I hope everyone, Suraksha, Anuj, Hanumanta, Dayanand, Pragati, Savya, Narasimha, everyone understood this additional depreciation. So now next thing we have to see, after knowing the additional depreciation. Yes. So now next thing we have to see after knowing the additional depreciation is the rate of depreciation. As per the rule 5 clause 1 given below, there are various block of asset is given. Then there are two parts they have made. That is, assets can be divided into two parts. That is, one tangible asset and second is intangible asset. Tangible asset, we know it consists of all the fixed asset and all the current asset. Then intangible asset, all the services it consists. So now part A, tangible asset, building. So first we are concerned about building only. So there are three columns. One is regarding block, one is regarding particular, and one is regarding percentage. So under building, first block 1, building which is used for residential purpose, 5% depreciation you have to charge. So building in which people live, or it is mainly used for residential purpose, 5%. So in a problem, building usually they'll give you 5% of building or 10% of building. So we have to consider here 5 or 10% depending upon the written down value. Written down value, we are talking about written down value method here. So block 1, building which are used mainly for residential purpose except hotel and boarding houses, that is 5% depreciation is allowed. Next, block 2, that is under building block 2, buildings which are not used mainly for residential purpose. In that case, a 10% depreciation. Residential purpose 5% and non-residential purpose 10%. So you have to remember this table also. Table and a certain rate we have to remember before solving depreciation problem. Next, block 3, building acquired on or after 1st September 2002 for installing machinery and plant forming the part of water supply. Suppose in the building certain machinery is installed for dealing with water related activity, water supply, or any other water related activity, then the building percentage of depreciation is 40%. But best thing in our syllabus is they'll give you the rate of percentage. Percentage rate will be provided by them in the question. So only thing you have to do is you have to identify the date of purchase, date of putting the asset into use, and you have to see when the asset is sold. So if you know these three things, then you have to follow the format. First, written down value, that is the previous written down value at the beginning. Then to that you have to add any addition made or any purchases. Then from that you have to deduct any transfer or any sale. Then you will get a finally written down value before depreciation. Then after that you have to see this table, or you have to see the rate given in the question, and as per that you have to calculate depreciation. Less depreciation from written down value before depreciation, you will get written down value after depreciation. That is written down value at the beginning of next year. That will be our final answer. Yes. So now next one, block 4. Under building block 4, purely temporary erections such as wooden structure. So certain temporary arrangement is made as a part of a building. So in that case, what we have to do? 40% of depreciation we have to charge. So from the point of view of examination, only these two percentages very, very important. 5% building and 10% building. Next thing, after discussing the building, next thing comes one more fixed asset, furniture and fitting. First is building, second one is furniture and fitting. Again, under furniture and fitting, block 1 is there. So furniture and fitting means it includes various things like electrical fittings, any wiring made, any switches, any sockets and other fittings and fans. In that case, 10% of furniture is provided. So 10% of depreciation you have to take on that particular furniture. Again, in the furniture only this 10% value. So very simple to remember. Building 5% and 10% and furniture 10%. Next thing about plant and machinery, third category. Under tangible asset, third category, plant and machinery. So whenever there is a plant and machinery, we have already discussed normal depreciation plus if there is a purchase made after 2005, additional depreciation we have to provide. And again we have to see whether that plant and machinery is used for 180 to 180 days more, or if it is less than 180 days we have to reduce the depreciation by 50%. If it is used for more than 180 days we have to give full depreciation. Third one now, plant and machinery block 1. Under plant and machinery, after assessment year 2007 we can consider the motor car also. So general rate of depreciation. So general rate of depreciation for plant and machinery in the block of asset, that is 15%. So under 15% you can write motor car also. So motor car used in the business for running them on higher purpose. So in that case here they have given 30%, but from the point of view of examination only 15% car will be given. So motor car other than those which are used in the business of running them on hire, that is 15%. So again here we have to remember only one rate for motor car, that is 15%, that is block 1. So block no need of remembering, just you need to remember the percentage. Next block 2, motor bus and lorry. So motor bus and lorry comes in the category of a truck. So we can say truck, generally they give you 30% of a truck in the questions. So now we have to see block 2, motor bus and lorries and motor taxis used in the business 45%. See this, if it is used for business 45%, if it is used for other purposes then it is 30%. In the previous block 1 also, if it is used for business 30%, other than business purpose it is 15%. So here we have to remember the rate for truck, that is 30%. Next block 3, regarding molds used in rubber and plastic factory. So any rubber and plastic factory molds, that is 30%. We have to consider 30% here, rate of depreciation. Next aeroplane and aero engine 40%. All these things are not that important from the point of view of examination. Block 3 and block 4. Then block 5, air pollution and water pollution control equipment, that is 40%. Then block 6, if you see, plant and machinery used in semiconductor industry covering all integrated circuits, 30%. So here what you have to do, first you have to read all this block of asset. All this block of asset you have to read once. Then only you will get some fair idea about the rates. And you have to remember only certain rates which is asked regularly in the examination. Not all these rates are important from the point of view of examination. So now block 6, plant and machinery, semiconductor industry 30%. Life saving medical equipments, block 7, that is 40%. Then machinery and plant installed in water supply project, that is 40%. Again these things are not important from the point of view of exam. Oil well, that is 15% block. Renewable energy saving devices, windmills, electric generator, that is 40%. So all these rates we have to see. Then block 10, that is renewable energy. Then other electric device is there, that is 15%. Block 11 is there, that is about computer, including computer software. See, this computer is important now. So whatever is important, you have to remember the rate. Computer is very, very important from the point of examination. Rate of computer is 40%. You have to remember this rate. Sometimes they won't give you rate, just they will tell you that you have made the purchase of computer somewhere in between the year. Then in that case you have to remember the rate, that is 40%. Again book is very important. Book consists of annual publication or other than annual publication owned by the SSC carrying on a profession. So they will give you a book 1 lakh. The annual charges they will specify 10,000 or 20,000 including annual charges that they may give you in the bracket. So that is of no use, irrelevant. We have to see only original value of the book, that is again book rate is 40%. Block 13, book owned by the SSC for carrying on the business in lending libraries, that is also 40%. So computer and book you can say that is what, 40%. Then block 14, plant and machinery general rate. This general rate is important, 15%. So now plant and machinery general rate 15%, building 5% and 10%, furniture 10%, motor, truck 30%, plant and machinery 15%, plant and machinery 30% is also there, book 40%, computer 40%. So whatever I told, if you remember that much, that is more than sufficient. Then ship, under ship, that is main category, fourth ship, that is block 1, ocean going ship, that is 20%. Then vessels ordinarily operating on inland water and not covered by in the block 3, that is 20%. This is not that important. Then the block 3, speedboats operating on inland water, that is 20%. Again, that is not that important. So now important thing is this one, part B, intangible asset, block 1, only one block is there, know-how, patents, copyright, trademark, license, franchises, or any other business or commercial right of similar nature, that is 25%. So now intangible asset, we have to remember the rate, that is 25%.